Do UPSC ask questions? Do state PCS ask questions with respect to the economy? Yes. With respect to the reports? Yes. So they have asked a question on Global Economic Prospect Report 2015. Next year also they asked a report on global financial stability. So this is a global financial stability. RBI publishes with respect to India's financial stability, the similar report. Now let's see the means related topic. Questions. Examine the pattern and the trend of public expenditure. Faster economic growth requires increase in the share of manufacturing sector, right? And economic growth in the recent past. Now all these lines prove what? That UPSC asked 24, 23, 22. UPSC asks questions on the specific trends. What has just happened? The related issues. What has just happened in the last 1 year, 2 years? What were the major issues that government was facing? What were the major issues that the Indian economy was facing? What are your views on that, way forward and other things? Now, this report will help you to understand how India functioned in the last 6 months. Let's go through that. So before anything else, let's start with what this report is all about. So this report is published by RBI half yearly, that is last week of June and last week of December every year. So it is published twice every year, June and December. Objective. Obviously, it is talking about financial stability. So it will look into resilience of the India's economy. How India's economy is strong, resilient towards internal and external shock. Prepared by a subcommittee under Financial Stability and Development Council. What it covers? Global and domestic risk, whatever the risks are. Ability of the financial system, which includes banking system also. Can the Indian banking system withstand the international issues or domestic issues? Examine the key macroeconomic indicators like inflation, policy rates, right, GDP indicators, CPI, everything else. Monitor the level of non-performing assets, especially in the banks, because if NPA or non-performing assets in the banks are very high as a ratio, as a share, if it is in double digit, it's like a threat to the economy, because banking sector may collapse. However, what the report says is actually not that much of a stress. However, the report has given us a kind of a warning signs this time. Let's understand what those warning signs are. Now, the report that we have taken is taken from the website of RBI. So, on the website of RBI, this report has been mentioned explicitly. So, highlights have also been mentioned. Let's understand them one by one. Financial markets remain volatile. Volatile basically means, especially stock markets, the banking sector, the value in those sectors and markets have been going up and down very, very high. So volatility is very high. Then comes public debt. Public debt is increasing because most of the states are going with high fiscal deficit. They're spending more. Central government has been spending more. The reason is the COVID. So after COVID, just to bring back the economy on the last track, 7% of an annual growth rate, 8% of the annual growth rate, both center and the states have been making fiscal deficit as an attempt. Indian economy remains key driver of the sound macroeconomic fundamentals. Yes, this is true. So Indian economy's fundamentals are very strong. Be it the tax to GDP ratio, be it the export or you can say openness of the trade in India, be it the inflationary parameters, be it the policy rates, every parameter is sound and strong. Health, balance sheets of the banks are healthy, right? Even for the NBFC, it's healthy. We'll just look around that. Corporate balance sheet is strong. So banks, corporate sector, non-banking finance corporations, foreign exchange reserve, which has already crossed 700 billion, seems okay. But still, RBI has given a warning. Globally, the wars are taking place. Israel, Iran, wars have been taking place. We have already discussed, prepared a video on that. If you want to go, you can go through one of the current affairs we have discussed last month, in which we have talked about Iran-Israel conflict and the international repercussions. Similarly, India had a conflict with Pakistan. Russia, Ukraine are also at a war. Then Trump administration is trying to impose too many tariffs across the world. So that brings a kind of a instability at the global level. So those instability are there, but still the report proves that India remain resilient. Indian economy remain resilient. A accommodative monetary policy has been adopted. So almost like 100 basis point have been sacrificed by the RBI in the last 2-3 monetary policies to keep the demand at the upper side. Now when RBI is doing that, it is following the accommodative monetary policy. Robust capital buffers, multi-decadal low non-performing assets. So NPAs of the banks are all-time low now. Multi-decadal means for the last 30-40 years it is now one of the lowest. Capital buffers are adequate with all the banks, so they are resilient. Most scheduled commercial banks have adequate capital buffers, which is right as per the minimum requirement. Non-banking finance companies remain healthy with sizable capital buffers. They are also on the healthier side. Consolidated solvency ratio in the insurance sector is also remained above the minimum threshold. So be insurance, be it banking, be it non-banking, be it the stock market, corporate bonds, government market, everything seems to be stable in this report. However, issues. Now comes the real problem. Now the report has highlighted that although Indian economy is very resilient, however, it still faces certain issues. What are those? As policy rate have declined, repo rate, CRR, SLR, CRR, repo rates have been declined. LAF has been very accommodative in the past few monetary policy reports. Despite that, now please understand this, the loan rate has declined. So the lending rate has declined. So loan rate has declined, but fixed deposit rate is high. So if I am as a consumer, because fixed deposit rates are not turned overnight, they do not change overnight, but lending rates may change. So as repo rate declines, as CRR declines, banks can put more money in the hands of the consumer, to attract business. However, with this, fixed deposit does not change. Now, the loan which they are offering at lower price, so they are selling at low, but they are buying at high. It means what? The bank's margin, which is known as net interest margin, is thinning. Thinning means it is becoming very, very small. So their margin is thinning up. As a result, there's a decline in the credit growth, especially in the consumer credit and NBFC. So in the near future, you will find that consumer loans, which are easily being dispersed by the banks, are declining or on the declining trend. NBFC faces the same thing. And this is especially with respect to the credit card loans, where the insolvency is very high. Share of the term deposits and the certificate of deposits have increased, right, over the current and the savings account. Gross non-payment performing assets are all-time low. So this 1.8% is gross NP, all-time low. It's all-time low. But write-offs are the major reasons. Now, what is write-off? Now, write-off basically means, we have already conducted a video on this channel, so you can go through that, how NP and other things have been defined. So write-offs basically means whatever was negatively written, that let's say 10 crore of loan has not been recovered by a bank. Now it has been write-off. Write-off means it has been removed from the books. Banks may try to recover the loan, but on paper it's not there. So when we remove it from the balance sheet of a bank, balance sheet of the bank becomes clean. And as a result, the banks can show that they are healthy. So this 1.8% of the gross NPA is because of majorly of the write-offs. Now, some biggest thing is the slippage ratio. Slippage ratio means how much of a quality loan is turning into NPA. How much of the quality loans or the lendings are slipping into the NPA. That is slippage ratio. So among the upper layer of NBFC, it is 70%. So the slippage ratio is very high in NBFCs. So their loans are turning into negatives or NPAs. They are slipping easily into the NPAs. Not only that, most of their NPAs, their write-offs are very high. They are writing off 70% of their NPAs, which is a wrong practice. It may seem good in the near terms, but RBI has given a warning for that NBFCs should not do that. They are easily writing off the loans. If you are still here with us on this video, I hope to see you in my batches. So the link is given. I'm floating a batch for specialized general studies economy. The prices is 5,999. The contact number is mentioned over there. The details, the link to join this is mentioned in the description box. All the details of this course are mentioned on the screen. This is going to be the most detailed discussion of economy. Do join me and learn from the best. I am Jateen Bharadwaj. I'm an assistant professor of economics. I am one of the highest scorer in the Civil Services Examination, in fact in the optional paper as well. And I believe in teaching the most detailed discussion curated only for the UPSC examination. I hope to see you very soon in this course. Thank you everyone. Do subscribe us, join us for the next update.